Most traders spend all day staring at the 1 minute and 5 minute charts looking for their entries, but they never really stop to ask a much more important question. What is the market actually trying to do today? So in this video, I want to zoom out and show how I trade the daily candle itself. No indicators, no patterns, no random setups, just the logic behind how price moves, how I read it from the daily candle open towards key liquidity levels. Because at the highest level, there are really only two levels that matter on any given day, at least for me. That's the daily high and the daily low. Now, these aren't just highs and lows, they're actually pools of liquidity, a ton of resting orders. These are the levels where I see major reversals, major continuations. These are my targets of many of my trade entries. And for me, it was an absolute game changer once I learned how to use it. Now, I shared both of today's trades in real time with my free Telegram. In case you want to join my free Telegram, I'll link it in the description below. The trade happened during the New York session. Price ran one of these levels, the daily high, and delivered a move of just under 200 pips in about 15 to 20 minutes. That move didn't just happen because of news or luck. It happened because price was doing exactly what it was designed to do. So let's dive right in. Every day, the first thing I'm going to do is I'm going to go to the daily chart and I'm going to mark out the previous day's high and the previous day's low. So the previous day right now is this candle. This is today's candle. This is yesterday's candle. So I'm going to mark out the high and the low. These two levels are going to be those two liquidity levels that I'm going to watch for the rest of the day. When price gets there, I'm going to watch and see how it reacts. These are going to give me my trades and my bias, whether or not I should lean towards continuation or reversal. Now, going into the 1 hour chart, what I'm going to realize is that the previous day actually opened up with a gap. This is something that has happened quite often with gold this year. But because it opened with a gap, some might look at that and immediately get bearish. I'm not bearish. The reason for that is market structure has been strictly bullish. We're forming higher highs and higher lows. Price has been trending higher. There's absolutely no reason to be bearish yet. If I look at that gap, what I'm thinking to myself instead is if price does reverse after a key liquidity level, that might be a potential downside target to go and fill it. It's not something that I'm looking at and thinking to myself, I'm immediately bearish on price action today. It just seems like a potential price target for me. Now, another reason is today was actually CPI. And so after a daily candle where you get a trending candle and the next day is a big red folder news event like CPI or NFP, price tends to end up ranging for the most part and then sweeps liquidity or makes its real move during or right after CPI. So I had no reason to go into this day feeling bullish or bearish. I was just waiting to see what price was going to do after I marked my levels. So after I mark my previous day's high and previous day's low, what I'm going to do is think to myself, okay, what are the possibilities that could happen? What are the possible outcomes that could take place today? So the first thought for me was, okay, the bias is overall bullish. So on a normal day, if my bias is bullish, I'm going to look to favor buy positions and target the previous day high, meaning I was targeting this level today, right? We're going to ignore all of this price action over here just because this hadn't happened yet when the day began. So I could almost use the instant replay, and the daily opened just about here. So going into the day after marking these two levels, notice how close price closed to the previous day's high compared to the previous day's low. Naturally, the bias is going to be, okay, if I'm bullish, I'm going to lean towards buy positions to eventually target this high. That's my first scenario. The second scenario, especially given that it's CPI going into today, is that price could range, it could move sideways, and eventually go for the daily highs during or after CPI, after which I'm going to look for a reaction to either trade the continuation or I'm going to see if I can get the reversal. Now, I personally like trading reversals after sweeps of daily levels. I don't like to trade the continuation as much. I feel like the reversal is just a higher probability trade. If you're trading a continuation after price has already gone above the previous day's high, usually you're trading the latter half or the latter quarter of the move that's left because it's already been trending higher for most of the day. So I would much rather look for a reversal. And that's why, seeing the way price closed this way, I was thinking, okay, my second option is if CPI pushes price higher, I want to see price get rejected up here and eventually come back down. The interesting thing is that both of these options were actually available for trades today if you knew when to look. So really the next step for me was to wait and just see what price wanted to do next. Now, having marked our previous day's levels and outlining the two potential game plans that we had for today, I'm going to go down to a lower time frame to see what the price action was like leading up to CPI and also what happened after that eventually got me to take my trade. So I'm on the 5-minute time frame, and what I see right away is that before the New York session started, price was pretty much just ranging over here, going sideways, right? And immediately before the New York session, which started right around here, price formed these relative equal lows. So what's really happening is liquidity is being engineered. Now the New York session starts, we push down, sweep those liquidity levels, and immediately we get a reaction. Now here's a change in state of delivery. We also get a structure shift. And all I'm thinking to myself is, okay, we've just swept liquidity going into the New York session. We've got our structure shift, got our change in state and delivery. What's my target going to be? And so, like I mentioned previously, the target's going to be the daily high, right? Most moves, whether bullish or bearish, start with liquidity sweeps. Price doesn't really move without first sweeping some sort of liquidity. It could be a lower time frame level, it could be a higher time frame level, it doesn't really matter. The New York session here, before its push higher, sweeps the liquidity that was created prior to the session, right? That push down after sweeping liquidity was the precursor to the move higher, right? And there were entries here, whether you want to trade this fair value gap, though that would have been after this initial leg higher. You could have taken a trade right after the structure shift, or on a lower time frame, you could have looked for entries. I posted this on my Telegram channel, which I will be linking below. I posted this particular fair value gap as a potential level to then target higher prices. So if I just play this out, price eventually makes its way up there, which is actually where the next part of my plan happened. So I want to state something, that just because this happened does not guarantee that price is actually going to move up here to the previous day's high. I'm mentioning it as a way of framing where I believe price is going to go because I know it's a liquidity level. However, the market is never really certain, right? There's always going to be that element of uncertainty. And so the best thing you can do, or the best thing that I could do, was formulate a model, backtest it to gain some confidence, manage risk, knowing that it's not 100% guaranteed, and just stay true to the process, right? Do my best to find high probability trades. So my personal preference was to get the second one, which I eventually did. However, as price moved to that, I also got the first one, right? We found a bullish move towards the daily high, and there were trades on the way there. So as price gets up here, sweeps the previous day's high, what I noticed right away is that it's unable to stay above, right? We get this rejection right away, and this is just showing me a lot of weakness after this initial move up. Now, it helps to know the type of price action that you see during red folder events like CPI and NFP and FOMC. Oftentimes, what happens is there's a fake out move, and traders are going to be trapped into taking a particular position. They're going to get stopped out, and price is going to reverse and go the other way. This is a very common signature for us. So I could not rule out the possibility that we were just going to continue on higher and higher and higher. So once I see price go up, sweep liquidity, and get rejected, now I'm already thinking, okay, the second plan, the second thing that I outlined has a pretty decent probability of playing out. However, this by itself is a bit of an aggressive entry for me, and I'm not really looking to take it. Instead, what I want to see is a bullish PD array be disrespected. Now, the closest bullish PD array over here is this bullish fair value gap. So for me, the first real sign that price is ready to move lower is once price disrespects this. As long as bullish PD arrays continue to be respected, I really can't bring myself to change my bias. even though I see this engulfing candle. It's not enough, right? And so what I'm going to do is just continue to wait a little bit. And you see the next candle, we get a change in state of delivery, and it's also negating that bullish fair value gap and actually makes it an inverse fair value gap. When I saw this candle closure, that was it for me. That was the go sign. This is now an inverse fair value gap. We've got a bearish engulfing candle. I'm thinking price wants to go sweep this liquidity all the way down here. So that was a move that started from 46.19, 46.20 and moved all the way down to 4600. That move took about 15 to 20 minutes. Right there. Right? So price comes back up, trades into that inverse fair value gap, gets rejected. So price comes back up, trades into that inverse fair value gap, gets rejected, and immediately pushes lower. The point of this is to show that price tends to give these signatures of where it really wants to go, but every model needs to be. So price comes back up, trades into that inverse fair value gap, gets rejected, and immediately pushes lower. Hopefully this gives some educational insight into how the daily candles can really help give key liquidity levels and give some really good setups. Again, it's really important to remember that nothing is for certain. Even if you're using high probability levels, that's just not how the markets work, right? Every trade has the potential to be lost.